When you think about the world of investing, one name just consistently rises to the top: Warren Buffett.
Absolutely.
Yep.
He's more than just a really wealthy investor. People are genuinely fascinated by him.
So, for you today, we thought we'd take a deep dive into the core of his investing philosophy, try and make it make sense.
We've looked at quite a bit, everything from his early days with Benjamin Graham,
Mm-hmm.
the father of value investing,
Right.
to the actual principles he uses, and even, interestingly, some of the mistakes he's made and learned from.
Yeah, the mistakes are good. So our goal, really, in this deep dive is to pull out the essential nuggets so you can grasp his ideas without getting, bogged down in jargon. We're going to unpack key things like value investing, finding those hidden gems, the importance of patience, just waiting.
Which is harder than it sounds.
Oh, definitely. And why Buffett insists on really understanding the kind of nuts and bolts of a business.
We'll use examples too, right? Like Coca-Cola, Apple. Make it concrete.
And share some of those great quotes he has. And importantly, connect it back to you, the listener. Show how these ideas, even though they came from the US market, can work for investors anywhere. Okay, so let's get started. Where do we begin with Buffett?
Well, you almost have to start where Buffett himself started, really, with Benjamin Graham, his professor at Columbia Business School.
Ah,
Graham wasn't just a teacher. He became a lifelong mentor, the father of value investing, as you said.
and Buffett was really keen to learn from him, wasn't he? I read he moved his whole family in, 1954?
Just out of school, young family, Omaha to New York, just for the chance to work for Graham.
That's dedication. And it wasn't just about finance, right? Buffett talks about Graham's character.
He does. His kindness, his generosity. Buffett said Graham never expected anything in return, just shared his wisdom. And Graham gave him some, let's say, grounding advice, too. He told the young Buffett, basically, don't worry too much about making money. It will change how your wife lives, but not how you live. And he apparently joked, you and I will still wear the same clothes and eat at the same cafeteria, so relax. Focus on the principles.
It gives you a sense that Graham taught him money wasn't the goal, just maybe an outcome of doing things right.
And Graham's own motivation, interestingly, was quite personal. He wanted to make sure his mother was financially secure.
Ah,
And that need pushed him to develop security analysis, value investing, as a way to make a solid living.
wow. So Buffett really looked up to him.
Hugely. He called Graham my hero and my friend. That says a lot.
Yes, it does.
Kept photos of him in his office. Said it helps to have heroes who are better than you. People to aspire to.
And it wasn't just Graham's brain, his intellect, that impressed Buffett.
No, I mean, he admired Graham's mind, definitely. But Buffett really highlighted his generosity. An absolutely open-ended, no scores kept generosity of ideas, time, and spirit.
That really paints a picture.
And you can sort of see that reflected in Buffett's own approach later on, his philanthropy too. That relationship with Graham, it really set the foundation, ethically and intellectually.
Okay, so Graham laid the groundwork. Now, let's get into the core strategy for our listeners. Value investing. What is that, really?
Okay, so value investing. At its heart, it's about finding good businesses whose stock price is, well, less than what the business is actually worth. It's intrinsic value.
Like finding something quality on sale.
Exactly like that.
Hmm.
Buffett defines intrinsic value as the discounted value of the cash that can be taken out of a business during its remaining life.
Okay, so future cash, discounted back. Sounds a bit technical.
It involves looking ahead, yeah. But the key is focusing on the business's long-term earning power, not just the daily stock price noise.
Right, but figuring out that future cash, that's not an exact science, is it? Buffett admits that.
Intrinsic value is an estimate, always. Different people can look at the same business, same facts, and come up with different estimates.
So how does he approach making that estimate?
Well, he's mentioned using something safe, like the interest rate on a government bond, as a kind of benchmark, a risk-free return.
Okay, to compare against.
Exactly, to see if the potential return from the stock, which is uncertain, is worth the risk compared to that safe return. And he often thinks about cash flows over a long period, maybe 10 years.
10 years, that's a long time horizon. And what about specific financial numbers? What helps him gauge this value?
Things like earnings per share EPS are important. That's the profit per share of stock. It connects to the company's book value, basically its net worth per share, and its ability to potentially pay dividends to shareholders, to you. Buffett sort of thinks that the yearly change in book value can be a rough guide to the change in the real underlying intrinsic value. So watching those fundamentals gives you clues.
So it's not just about finding any cheap stock. It's about finding good, solid businesses that happen to be undervalued right now.
And that's why he puts such a huge emphasis on really understanding the business itself, not just the stock ticker.
Makes sense. So what does he look for in the business fundamentals?
He looks at several key financial metrics to sort of gauge the health and quality of the business.
Okay, let's break some of those down for the listener. What's important?
Well, one big one is return on equity, or ROE.
ROE. Okay.
Think of it like how well the company uses the money shareholders have invested to actually make a profit.
Like a performance grade for management?
Sort of, yeah. And Buffett likes consistency here. A good track record, maybe 5, 10 years. He wants companies that consistently earn high returns.
Okay, consistent profitability. What else?
Debt. Specifically, the debt-to-equity ratio, or DE.
Right, how much they owe versus how much they own.
Exactly. And Buffett generally prefers companies with low debt. He wants to see growth funded by the business's own profits, not just by borrowing more and more.
So less reliance on borrowing is a good sign.
Generally, yes. Though there's nuancing, like long-term leases might be viewed differently than straight debt. But the principle holds. Aiming for, say, below 0.8 is a rough rule of thumb people mention.
Got it. Low debt. What about actual profits? Margin.
Absolutely critical. Profit margins. How much profit they squeeze out of each dollar of sales.
Mm-hmm.
He looks for consistent margins, ideally increasing margins over at least 5 years or so. It suggests they control costs well, maybe have some pricing power.
It really sounds like he wants you as an investor to understand the engine of the business, not just the shiny exterior.
That's a great way to put it. Remember his quote, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes."
That really drives home the long-term thinking.
It shows how important understanding the business's durability is, and why he tends to avoid companies whose products are, well, just like everyone else's, commodities.
Right, where there's no real difference. He wants something special.
Something with a competitive edge, which leads us perfectly to his famous concept.
The economic moat.
The economic moat. It's such a brilliant analogy for thinking about a business's strength.
Explain that for our listener. What does he mean by a moat?
Okay, so imagine a castle. The moat is the ditch filled with water around it, protecting it from attackers.
Right. Keeps invaders out.
Well, an economic moat does the same for a business. It's a durable, competitive advantage that protects its profits and market share from competitors over the long run.
So what kinds of things create this moat? What are we looking for?
It can be several things. A really strong brand name is a big one. Think Coca-Cola.
Instantly recognizable. Global.
Huge moat. Or a cost advantage, being able to make things cheaper than anyone else. Think maybe like Geico in insurance, historically. Network effects, where a service gets more valuable as more people use it, like a credit card network or maybe a big social media platform.
Right. Everyone's on it, so you need to be too.
Things like regulatory licenses can be a moat too, limiting competition, or high switching costs. It's just a pain for customers to leave. Think maybe some enterprise software.
He has some great quotes about moats, doesn't he? Very vivid.
Oh, yeah. He loves the analogy. In business, I look for economic castles protected by unbreachable moats.
Unbreachable. Strong word.
And he added, with that typical humor, what I love, of course, is a big castle and a big moat with piranhas and crocodiles.
Huh. Okay, maybe not literally.
No, but it emphasizes how strong he wants that defense to be, even sharks in the moat to keep competitors awake. It just shows how vital that sustainable advantage is to his thinking.
You mentioned Coca-Cola. How does that fit the moat idea? He invested way back, right?
Yeah, 1988.
Yeah.
And Berkshire still owns a huge chunk. Coke is classic. Immense global brand power, plus this incredible distribution network.
Hard to copy that.
Extremely hard. That's a wide, deep moat.
What about a more modern example? Like Apple. People talk about their ecosystem.
Apple's a great example of a multifaceted moat. You've got the brand loyalty, definitely, but also the ecosystem, the iPhone, Mac, iCloud, App Store. It all works together, creating high switching costs. Plus, their control over design, their supply chain, it's formidable.
Okay, so it's not just one thing for Apple. And you also mentioned See's Candies earlier. That seems different.
It is different. Berkshire bought See's way back in '72. It's more of a regional powerhouse.
Right. West Coast, mainly.
Yeah. Strong brand loyalty, known for quality, allows them to charge a premium price. And their direct sales model, focusing on freshness, it creates a specific, defensible niche.
So a narrower moat, maybe, but still effective.
Exactly. It shows moats come in different shapes and sizes, but the key is durability.
Which means, as an investor, you need to recognize these aren't static. Moats need defending.
That's absolutely critical. Advantages can fade. Competitors adapt. Technology changes. Companies have to keep investing in their moat.
And that ties into another Buffett idea, doesn't it? About diversification.
Right. He famously said, wide diversification is only required when investors do not understand what they are doing.
Controversial.
A bit. But his point is, if you really understand a few businesses with strong, durable moats, you might not need hundreds of stocks. You concentrate on your best ideas.
Okay. Understanding the business, finding the moat. What else is core to Buffett's success? Patience comes up a lot.
Oh, patience is absolutely fundamental. His whole strategy is built for the long term. It's not about quick flips or timing the market.
Resisting that urge to constantly tinker.
Exactly. You need patience to let good businesses grow, let their value compound, and let the market eventually recognize that value. It means tuning out the daily noise.
He has some pretty blunt quotes about time frames, doesn't he?
He does. That 1996 letter quote again. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
10 years is the minimum thought process.
Yeah. And even more extreme, he said his favorite time frame for holding a stock is forever.
Forever. Okay, maybe not literally forever, but it makes the point. Buy and hold. Really hold.
It's just such a different mindset from the constant churn you see in much of the financial world. But the payoff, in his view, comes because, as he said, a single winning decision can make a breathtaking difference over time. Find a few great companies, hold on, and let them work for you.
Okay, so find value, understand the moat, be patient. But it's also good to remember even Buffett isn't perfect, right? He's made mistakes.
Absolutely. And he's been remarkably open about them, which is fantastic. They offer huge learning opportunities for the rest of us.
What's the big one he talks about? Didn't he call buying Berkshire Hathaway itself a mistake?
He did, which sounds crazy now. But he meant buying the original textile business. He called it the dumbest stock I ever bought.
Wow. What happened then? This was back in the 60s.
Yeah. His investment fund was buying shares in this struggling textile mill. He apparently had a verbal agreement with the boss, Seabury Stanton, to sell the shares back to the company at a specific price.
Okay.
But then the formal written offer came in lower. Buffett got mad.
Ah. An emotional reaction.
Seems like it. He retaliated by buying up enough shares to take control, fired Stanton, and found himself stuck running this terrible textile business.
So taking over was the mistake, driven by anger.
That's how he frames it. And while he brilliantly pivoted Berkshire into the giant it is today, he figures sticking with textiles for maybe 20 years. Cost. Well, the opportunity cost was immense.
How much?
He's estimated hundreds of billions, maybe even $1 trillion in value that could have been generated if that capital was invested better from the start.
Wow. That's
Yeah.
a big number. What other mistakes has he mentioned? Things listeners might recognize.
Selling Disney too early is one he's talked about. Bought a chunk in the 60s for not much, sold it for a decent profit fairly quickly.
But missed the massive run-up later.
Exactly. Left potentially billions on the table.
Yeah.
A mistake of omission, not doing something. He did get back in later, but yeah.
And he's mentioned entire industries he got wrong.
Airlines are the famous one. His investment in U.S. Air back in '89.
Right. Well, what wrong there?
He put a lot of money into preferred shares, but just came to realize the industry economics were brutal. Intense competition, high fixed costs, cyclical demand.
Yeah, tough business.
He basically concluded, frankly, no airline is going to be a wonderful business. And that led to his famous, slightly dark joke.
The Wright brothers one.
Yeah, that if a capitalist had been a Kitty Hawk in 1903, he should have shot down Wilbur Wright. One small step for mankind, he said, and one huge step back for capitalism.
Huh. That's grimly funny.
Hmm.
So what are the big lessons for us as everyday investors from these mistakes?
Well, one is definitely the importance of thinking for yourself. Don't rely on tips or forecasts. Remember his line, never ask the barber if you need a haircut.
Good one. Do your own homework.
Exactly. And market forecasts. He says they usually tell us more of the forecaster than of the future. Focus on the business, not the predictions.
And his mistakes also seem to reinforce that moat idea, right? Understanding the durability of the advantage.
Definitely. He admitted many of his errors came from underestimating how weak a company's competitive position really was. Those narrow and shallow moats proved vulnerable.
So really dig into how strong that competitive edge is.
And remember those errors of omission he mentioned with Disney. He said the mistakes you don't see in our case are way bigger than the mistakes you see. Missing a great opportunity can be more costly than making a bad investment sometimes.
Okay, so bringing this all together, how can our listener, wherever they are in the world, actually apply these Buffett lessons today? Is it still relevant?
Oh, absolutely. The core principles, they're timeless. Value investing focusing on business worth, not just stock price, works anywhere.
Even with all the fast changes, tech, globalization?
Especially then, I'd argue. Thinking about a company's moat, its competitive shield, is crucial because things change fast. What makes this business defensible? That question is universal.
So even in new industries, ask, what's the moat?
Exactly. And really try to understand the business before you invest. That applies whether it's a tech startup in Bangalore or a consumer goods company in Berlin. Avoid things you just don't get.
And the patience piece. That feels more important than ever with all the short-term noise.
Totally. Resist the urge to constantly react. Focus on finding good companies with solid track records, honest management, and hold on. Let compounding work.
And keep expectations realistic, right?
Yeah.
He's warned about that.
Yes. Expecting, say, 15% returns every year forever from the whole market. He calls that nonsense. The market, overall, can't sustainably grow that much faster than the underlying economy.
Right. You can't have infinite growth on a finite planet, as someone said.
Exactly. Or, as Buffett puts it, investor returns ultimately come from what the businesses actually earn. Focus on that reality.
Okay, so let's try and summarize the absolute key takeaways from this deep dive for everyone listening.
I think it boils down to a few core things. 1, focus on value, not just price. 2, understand the business, especially its competitive advantages, its moat. 3, be patient, think long-term. And 4, learn constantly from successes, from failures, yours and others, like Buffett's.
And these aren't just American ideas, are they? They feel pretty global.
Completely. Sound business analysis, discipline, a long-term view, those are valuable for any investor anywhere trying to build wealth over time. They're just principles of intelligent investing.
Okay. So, a final thought for you, our listener, to maybe chew on after this. Start looking around at the businesses you interact with every day, where you shop, what you use. Ask yourself, what's their moat? What protects them from competitors? And critically, how sustainable do you think that protection really is?
That's a great exercise.
Yeah.
Starts training that value investor muscle.
Exactly. Just thinking that way is a big step. And hey, if this sparked your interest, definitely check out Berkshire Hathaway's annual shareholder letters. Buffett writes them himself. They're full of wisdom. Or go back to the source, Benjamin Graham's writings.
Absolutely. Lots more to explore there.